Sorry about that. Thank you so much, everyone, for coming out and joining us today. My name is Bob Bradshaw. I'm a tax partner here at William Long Company. Been in the practice for about 15 years or so. I have our manufacturing, our salt, and our M&A segments here. So I spend a lot of time dealing with taxes and how they affect a lot of our businesses in the Northwest Ohio area. We're certainly in a unique year, as I would describe it. We're just in an unknown situation. And to kind of say that we're going to know where we're at the end of the year would be frankly lying to you guys, mainly because the Democrats don't know where we're going to be. And what I mean by that, just taking a step back, this presentation has evolved over the past week and a half because what we thought was going to happen last Monday changed Thursday when Biden introduced the Build Back Better, or revised it. So originally he had come out with what was a $3.5 trillion plan. And with that plan, there were certain revenue raisers in that plan. Then he scaled it back to about a $1.8 trillion thing. So cutting out a lot of the things that Ruben and I definitely thought were going to be in the bill, mainly the tax rates, which aren't there anymore. And Ruben will get back here shortly. And then just last night, Senator Joe Manchin, many of us may have saw that, said he's not even going to vote for this $1.8 trillion bill. What that means is, taking a step back, is we are in a unique year that we were back in when we were in 2017. The Democrats control the House, the Senate, and the presidency, obviously. What that means is they can pass legislation using what's called the Reconciliation Act, meaning they can use a simple majority as long as it doesn't add to the national debt after a 10-year period window looking at it. So as long as everyone votes to approve it, in the Senate, which is mainly where we're at, because we're at 50-50 divide, meaning that we don't need a Republican to vote for it. The VP can break the tie and it can become law using this Reconciliation Act. However, it empowers a lot of these senators to get what they want through the bill. So that is why we're seeing changes, and we're going to continue to see changes. So as Ruben and I were talking late last night, it's like, well, what do we want to present to everyone today? Because we don't know where we're going to be. So we thought about, hey, let's just talk about what we've seen, what they're talking about in Congress, and then what the current law is, to kind of give you a perspective of what they're thinking, why they're thinking it, and then maybe set yourself up at the end of the year to take advantage of certain things. We're definitely not sitting here telling you, hey, let's make some permanent decisions based off of that. We're not saying, hey, you have 130 employees, spin off 40 to avoid the COVID mandates. We're not saying, hey, throw all your investments into a permanent trust, an IREV trust, something like that. But we're going to give you some ideas and hopefully give you some thoughts as we continue down on some temporary things we can be doing. So with that being said, I'm going to take it over to Ruben here, and he's going to kind of talk about the rates and where we're kind of at.
Yep. So first off, I guess just a little bit about myself. So for the better part of the last 9 years, I've been at William Long Company doing tax work. Had a brief stint at the Andersons in the tax department there. So I've been doing taxes for the last 9 years of my life, however you want to look at it. So that's where I'm coming from. All this stuff kind of excites me. The changes excite me. It gets crazy. It gets at times frustrating, but it's also fun, right? It's fun to dig deep into this stuff and figure out things that we can help you guys with, for sure. So the first thing I want to touch on is individual tax brackets and tax rates. So just kind of some background, right? As Bob was pointing out. So just back in September, the House Ways and Means Committee came out with their like tax plan or tax proposals, stuff that they wanted to kind of see Congress put in legislation to pay for some of the things that they wanted to do. One of the things that they included in that plan was an increase to the highest tax bracket on the individual side. So an increase from 37% to 39.6% for the highest rate. As of now, that is not in the Build Back Better Act. And so that likely means that's probably not something we'll see in the foreseeable future. But we did want to touch on it just to kind of give you guys an idea of where things are at. And the fact that it's not currently looking like it's going to happen, that increase in tax rate. And then the next thing, kind of a similar concept, right? The capital gains. So capital gains historically been highest tax rate at 20%. One of the things in that House Ways and Means Committee tax plan was an increase to that highest tax rate to 25%. Again, that is not in the Build Back Better Act. And not in, so there's another, kind of go back a little bit, there's another $1 trillion infrastructure bill that's kind of on hold in the House that they're kind of trying to tie to the Build Back Better Act, not in that infrastructure bill either. So not looking like something that we'll see in the foreseeable future with that as well.
Right. And to that point, we kind of see on the last slide is they're talking about instituting this at the 400, 450 thresholds, whereas we can see the 37 doesn't come into effect until 523 or 628, depending on your individual situation. So why that's important is we're probably in the lowest taxing situation that we'll ever be in. So we may want to really think about back in the 2012 timeframe where we started accelerating income and postponing deductions to try to recognize it in these years. Especially, this is one of my favorite charts, as we pointed out, is especially let's take advantage of that 15% tax rate because we can go all the way up to 500,000 if you're married. We know that they're trying to increase capital gain rates. Probably not going to happen anytime soon, but we don't know that. They tried, and when they actually instituted that, you can kind of see they instituted it as a date during the year. So if they come back and say, no, in December, we're going to institute it again, well, now it's too late to do something. So it's something to consider as you're moving forward. Should I be recognizing my cap gains up to that 20% threshold, or maybe even to the 20%, depending on how risk averse you are in maximizing those brackets. So now let's talk about something that was in both. One of my, I would say, this code section is well drafted. David Kurt drafted this. It took over 2 years to draft this code section. And if you actually read through it, it's really good. And I know I'm saying that as a CPA tax guy. So this is what gets me excited. I know I need a hobby. That being said, just so we're all on the same page, what this is, it's that net investment tax on your investment or passive income. It was instituted for the ACA, the Affordable Cares Act, to help pay for that bill back when it was passed. What they're talking about doing now is attaching it to the basically S Corp share income. So backing up, it is normally attached if you're a passive shareholder and your income is above $250,000. So those that are active, that's in an S corporation, aren't subject to this 3.8%. Well, they're saying, you know what, we're going to keep that old, and then we're also going to add on this new part that if your income goes above 500,000 or 400, depending on where you're at, we're going to attach a 3.8% on everything not subject to SC tax, meaning typically your S corp income. Why this is really important is that very last bullet there. It also is on the sale of your business assets and or stock. So the way it was drafted was you were not subject to the pass of the NITs if you were active in your business and you sell your S corp stock. So these are typically, as being an M&A guy, I see a lot of these deals where we're selling either our assets or our stock, and then you're avoiding this 3.8%. Well, now if they get this passed and you wait to sell your business until next year, if you're dealing with one of these transactions, we're advising clients to close as soon as possible, mainly now, before we can get real legislation out, because we're avoiding this new NIT, this 3.8%, which really can hurt your bottom line when you're figuring out long term, right? I mean, that's a lot of cash flow once you factor in everything else they're trying to do as well.
Yes, the next thing is that's kind of in the Build Back Better Act as well as the surtax. So from an individual standpoint, it might not be something that affects a lot of us. So they're talking at a modified AGI above 10 million, instituting a 5% surtax on the income above that, and then an 8% surtax on the income above 25 million. I think the big ticket item is that estates and trusts with AGI above 200,000 will be hit with the 5% surtax if this proposal gets put into law. And so what that $200,000 income threshold is on your undistributed taxable income from the estate or trust. So kind of simply put, in the estate and trust, say that they are an SBIT, they have ownership in a company, they have taxable income of $500,000. You distribute out $400,000 of taxable income to the beneficiary. They're left with $100,000 undistributed taxable income. That's the kind of number that we're looking at there. So if you're above that $200,000, you're going to be hit with 5% surtax on that amount. So the big item there to think about is making sure that we're doing the right planning to maximize that distributed out income, and taking advantage of all the things that we can do there.
Yeah, and that's a great point there, Ruby. And I kind of jumped over it a little bit, but as you can see, it says all trusts under this new NIT as well. So if you're an SBIT who owns an S corporation that makes $1 million, the point of being an SBIT is to keep that money up there. And so you're not having to distribute it out, take it out of trust, because the point of the trust is to keep your assets in trust. Well, now all of a sudden, you're going to get hit with an 8% tax plus a 3.8% tax surcharges, basically on top of your normal rates, which are already 37%. So this could really hurt a lot of states in trust. Now, again, as I started off this presentation saying is, don't run out and change anything right now. Keep everything in place, but be talking to the attorneys and us and everyone else to really try to get a picture of what you want and really sit down and really talk about your planning. And I'll get to the estate tab here shortly about what you really need and what we're trying to achieve. So again, just stuff to keep in mind. All right, so diving into section 1202. 1202 has been around for many, many years. As you can see, it was first enacted back in 1993. And what it does is it allows you to exclude the sale of your stock if you meet certain qualifications. Those qualifications are mainly the most important are, it has to be originally issued stock to you, meaning you can't buy the stock from someone else. And two, your assets have to be under 500,000 or $50 million, right? $50 million, your assets have to be under, and you have to sell the stock. So if you sell the stock, your assets never went above $50 million, and it was originally issued to it. Congress enacted this section that allows you to exclude up to 50% originally of your gain. Why this was important, or why we haven't really talked about it in years past, is back in 1993, the cap gain rate was 28%. So we got a 50% exclusion of our income, and then the residual was taxed at 28%. However, going forward, when the cap gains decreased, they never tied it back to 1202, meaning that you were still taxed at 28%. So in 97, 98, when it dropped down to 20%, and then when it dropped down to 15% in 2003 under the tax or the Bush tax cuts, what you got left with is if you think about it, I can exclude 50% of my gain, but I'm still taxed at 28% on the other 50%, making my realized gain or realized tax rate 14%. So there's that 1% arbitrage, right, which is okay. However, 1202 is tied to A&T, meaning there's a 7% preferential add back to A&T. And those of us that know A&T, mainly pre-TCJA before they were able to fix it, it was taxing a lot of our individuals, mainly because they didn't adjust it right for inflation. The phase outs were too low, and there was no SALT cap. Remember, the state and local taxes are an add back for alternative minimum tax. And those who don't know what A&T is, it's the heads you lose, tails they win. The government says, hey, you got to pay tax. And if you're not paying enough, we're going to make you pay even more. So it was this new taxing bracket or system they implemented where it was a 26 or 28% rate. Well, as you kind of see, after 2003, 1202 was kind of dead, right? Because there was no sense of jumping through all the hoops to try to get there. Well, in 2009, they realized that, and they wanted to invest or have people invest in these small corporations to try to get you to put more money back into the economy, right? Back when we were going through that recession time frame. So they instituted a 75% when they realized 75% was too low. They said, okay, after September 27th, 100% is going to be allowed for exclusion as long as you have the stock for 5 years. So if you held the stock for 5 years and you met the other qualifications, you get 100% exclusion under the tax code, right? Which is cool, but you got to think, if I'm to get this exclusion, I got to be a C corp, which the tax rate for C corps back then in 2010 up to 17 was, if you made above 335,000 or so, you were taxed at 34%. So that's why we've kind of never really seen 1202. Then all of a sudden, TCJA came out. And now all of a sudden, my tax rate went from 34 to 35% down to a flat 21%. 21% pretty attractive, considering now I can be at 21%, take out a dividend to me at 15%, and I'm at 36, basically there. And now I have the promise, or the thought being I can sell under 1202 and all my gains excluded. So right now in 18, 19, 20, we've seen a lot of corporations or individuals flip to C corps because of trying to get that original exclusion, all that. But if we think about it, it came in effect in 18. So right now we're in year 4 of owning the stocks. So we're going to be looking at year 5 coming up. So what they're trying to do is they're saying, okay, that's fine. This legislation is out there. But what we're going to do is anyone who makes above $400,000, you're not eligible for the 75 or the 100% exclusion. And it's effective back in September. So unfortunately, there's nothing we can do now. But again, it's just one of these cool code sections that are out there. I'm hopeful this doesn't get passed or doesn't go through because it's a unique situation because, again, you got to sell stock. How many businesses sell stock? Very slim, but it is definitely something to consider. And it's definitely something as you're negotiating your M&A deals or your deal is to make sure that you're talking about this with your team because this could save a lot of cash flow. And again, at the end of the day, Ruben and I both hate paying tax, and we're trying to just maximize your guys' cash flow.
Okay.
So.
Yeah. So another thing that the Build Back Better Act is trying to address is a pretty big loophole that's been around for the last few years with virtual currency. So under current guidance, virtual currency is treated as property, which means a gain or loss recognized to exchange for other property. So one of the big things that the Build That Better Act is doing is subjecting virtual currency to wash sale rules. So if we take a step back and say, okay, well, what is a wash sale? So a wash sale is say in terms of stock, right? If I buy some stock today for $100, and sometime in the next 30 days that drops to $50. So I say, okay, I'm going to sell it. I'm going to buy that stock back at $50, and I'm going to deduct the loss and get the stock at $50, and then make some more money. Wash sale rules kind of say no, you can't do that. You can buy the stock at 50. That kind of theoretical $50 loss you have to add back to your cost basis. So you're essentially back at your $100 cost basis going forward. So they disallow that $50 loss. Currently, right, virtual currency isn't subject to those wash sale rules. So someone could buy some Bitcoin at, let's just say $100. 2 days from now, it could be down to 50. They could sell it, deduct the loss, not have to adjust the basis, and go carry forward. So under the Build Back Better Act, subjecting that to the wash sale rules kind of limits a pretty big loophole there. Limits a lot of those losses that people were able to take over the last few years with it.
Yep. So what Ruben's basically selling is if you own a lot of Bitcoin in a loss position right now, sell it before the end of the year. This takes effect January 1st if they're able to pass it. A couple other things to really talk about virtual currency, because this has been a hot button topic for the past 2 years with Congress, mainly because we're just seeing the influx of everything, right? Between the Coinbase app and all of that stuff. I mean, a lot of us probably are aiming virtual currency now. So one of the things to remember as you're moving forward is if you buy and sell it through like a Coinbase app or something like that, it's an investment. It's like a stock. However, when you use it to pay for a service or exchange it for whatever you're trying to exchange it for, there is a deemed gain or loss at that point in time. So if you bought the Bitcoin for $100 and it went up to 150, and you use that to buy something else, you don't get to defer that basis, that 150 into that new asset. You have a $50 gain that you have to pick up. And then that's your new asset or whatever it is at that 150. So that's something to be cautious of and just be aware of if you're using that. Additionally, if you're a minor out there, that gain is considered inventory to you. And if you sell it or use it or whatnot, it's ordinary treatment, not cap gains. There's a lot of literature out there. There's a lot of stuff out there. We don't want to bore you guys to death because I know it's a unique situation for a lot of people. But if you're in that, happy to talk the details with you. So some things that we do know are that, hey, the standard deductions went up $300. I know, we're awesome. And then the singles went up 150. So why these went up so little is under TCJA, they changed how they index for inflation. They use what's called the chain CPI, which prior to this, they used a normal one. Again, what that just means is it takes into account for substitution products. What I mean by that is you're able to buy a substitution product. Maybe you don't need the latest iPhone. You don't need the 12, you can buy the 11, or I don't know what version we're on anymore, but it just takes into that. So it means we're not going to increase these deductions as fast. And unfortunately, as most of us know on this Zoom call, inflation is getting pretty high right now. So we're not going to see that same level of deductions on your standards and other items that we typically see, the bumps in retirement, which I'll get to here shortly, and stuff like that. You just don't see that right now. And it's going to unfortunately take an act of Congress to change that as well. Personal exemptions, they're still repealed. Those were repealed under TCJA. They're going to be repealed into 2026. And actually, that's a little bit of a misnomer. They're not actually repealed. They just made it zero. So they couldn't take it out of the code section, so they just made the personal exemption amount as zero.
And then, so a little bit about SALT. So there's been some talk in Congress and some talk among some Democrats wanting to repeal the $10,000 SALT cap. So if you recall back with TCJA, there was a $10,000 SALT limitation put in place on your Schedule A. So that's things like your state income tax, state sales tax, real estate tax, things like that. You can only max your deduction at $10,000 on the Schedule A. There was some talk to want to repeal that. Nothing is in any of the proposals, in any of the even any of the House Ways and Means Committee tax plans, those types of things. Nothing in there about it. But what we are seeing, and what the IRS is allowing the deduction at the entity level, and the pass-through credit that some states are doing. So some states are letting, and Bob can probably speak a little bit more on this, getting more on details on it. But some states are kind of letting you take kind of elect to be taxed at the entity level, and then you're able to take that tax as a deduction on the tax return, and then you get a credit for that at the individual level. So if you go to file in that state, you get a credit for the tax paid into that state, and also a deduction on your business income for that tax paid.
Yeah, so basically, you're pointing out is now I'm able to take that cap where it was capped at the individual level, put it back on the business. Before I was never allowed to deduct as a pass-through my taxes at the entity level. Now I'm able to deduct it as an entity, reduce my income that flows through on page one. And then also when I'm filing at the individual level, say New York is one of the ones that we'll talk about here shortly, is now I get a full credit on this. A couple things to point out. New York is the only one that I know of that we're late for. If you're just finding out about this, you had to elect, I believe it was September or October, you had to elect to be taxed for 2021, but you can go forward in 2022. All other states, as of right now, are going to let us elect either 21 or 22 when we file the returns. You would have to look at each individual one. But as you can kind of see, we said notice 2020-75. This isn't a regulation yet. So it's not actually in the code because of actually what Trump put in place was the regulation rules where you had to remove two to put one in. Well, they never got around to drafting the regulations. But so just be cautious of it. But many states have implemented this, and it's great for our pass-through entities, right? Because we were limited at that. So now what happens with this SALT cap, as Ruben said, it's not in the legislation, but a lot of the senators in high taxing jurisdictions, New Jersey, New York, California, those senators want the cap repealed because their real estate tax or their individual income tax, California is what, 13.3 if you're a millionaire, 12.3 if you're not. New York is now the highest taxing jurisdiction if you live within New York City. They want to be able to deduct that tax or have their residents be able to deduct that tax against federal income. So they want that, I guess, put it a different way, they want that subsidy against federal income tax. Where a lot of, it's funny, the GOP is like, well, no, you put this in, we're not going to let you just take this out because you now want a tax break for your residents. So it's kind of a weird position that we're in, and a lot of senators said they won't vote for the end bill if this isn't repealed. But again, this is going to be repealed to increase revenue or increase deductions, which decrease revenues. So they're going to have to put something back in to decrease that revenue or to get that revenue covered, right? So again, it's just something to think about as we're going forward, as we continue to hear more SALT type conversations is, well, what are they going to put in to cover this? All right, jumping over to retirement accounts. Basically, not much has changed for 21. It's still 19.5 for your 401k. Going to see about $1,000 bump next year to put into your 401s. There's still the $6,000 catch up for anyone. IRAs, it stayed $6,000 for each year with the $1,000 catch up. Your SEPs, we're seeing a little bit trickle up on that. You're allowed to defer up to $58,000. That's self-employment income. And then $61,000 next year. So those are pretty standards. Pretty much everyone's familiar with those. A couple things to keep in mind for 21 that was different than 2020. RMDs are back. Our required minimum distributions are back. Whereas in 20 we were allowed to postpone, not take those out because of COVID-related reasons. Additionally, if you took out the COVID $100,000 up to $100,000 threshold, and you'll have to pay it back over 3 years. Payment 2 is due this year. If you elect not to take it or to pay the entire amount back, you can go back and amend and stuff like that. So just be cautious of how you're treating that. But what we wanted to kind of talk about is what is in the proposals and what we saw originally versus what we're not now. Is the main thing was the elimination of the backdoor Roth. That was in the original thing. And the original bill that we saw, and now it's not in this one, but it could end back up. And what this all kind of generates from, or the genesis of this, is we may have heard back earlier this year, the founder of PayPal, Peter Thiels, or whatever his name is, he started back in 1998 or something like that, and had a $2,000 Roth, and he's now converted it up to what, $5 billion. Because he was able to defer and buy assets inside of that has grown and ballooned up so much that they're like, well, Congress is like, well, no, that's not fair. We want you to take it out and start earning money and paying on it. So they tried to put in these aggregate amounts above 500,000 or 10 million, and you got to take 50% out. And then if your AGI is above this amount, they're trying to get people to take stuff out. But they didn't get it in this new bill. And why that's important is that backdoor Roth is still out there. And what people may not know what the backdoor is, just taking a step back so we're all on the same page here, is if you make too much money to contribute to a Roth IRA, Roth IRA being is when you start drawing out after retirement, that money comes out tax-free, earnings too. Whereas if you invest into a traditional IRA, that money comes out taxable to you, subject to your basis if maybe you're a non-deductible IRA because your income's too high. And what that means is there's thresholds, right? So traditional, somewhere around 130,000 you can contribute to and deduct that or exclude that income from your taxes. Roth IRAs go up to about 190,000-ish. If you make above that, you're ineligible to contribute to a Roth, but you can still go back to a traditional. You just can't deduct that initial contribution of, say, $6,000. Well, what they did back in 2000, I believe it was 10, is they repealed the maximum amount that you're allowed to convert to a Roth, depending on your income threshold. So if your AGI was above certain amounts, you weren't allowed to convert your traditionals to a Roth. They repealed that threshold. So what that gives us the ability to do now is contribute, if your income level is too high, into a non-deductible IRA, get a basis of $6,000, then convert it over to a Roth. Your tax on your aggregate value of your IRA, which in this case is $6,000, minus $6,000, so you're taxed on $0. So I've now converted my traditional IRA to a Roth, even though I'm above the income thresholds. So it's a great planning technique. One thing I would be cautious of and warn everyone is I typically advise waiting at least one paper before you do the backdoor. And what I mean by that is wait at least 1 month to get that one statement that shows you converted to a traditional IRA, and then make a decision to do the rollover, because there's a thing called a step doctrine, which means if you're just doing these steps to get to this end result, they can come out and just nullify the entire thing. So it's just one thing to be cautious of. I always advise one paper. So wait 1 month. Yeah, you're going to pay a little bit of tax, but I'm guessing it's not going to, unless you're in Bitcoin, you're not going to have big up and down swings. However, in this new proposal, or in this proposal coming out on Thursday, there is still the DIS and foreign corps are ineligible to be in your IRAs. A DIS basically is that interest charge domestic international sales corporation. What that is, it's a fancy way of taking all your international sales and getting an ordinary deduction and picking it back up at capital gain rates. So if you have international sales, you can set up this company. It's a paper company. It's the only one that I know of the IRS allows us to do. It's a paper corp where I pay them a commission, they pay me a dividend back. So I've got an ordinary deduction for the commission, I pick up the dividend at capital gain rates. However, a lot of our C corporation entities would put their DIS ownership inside a IRA. Why? Because I pay over that commission, I now get a deduction for it, and then I pay it back, but I'm not going to pick up gains because it's going into my IRA. Especially if I can put it into a Roth IRA, now all of a sudden it's going to be tax-free when I decide to draw it out. Well, they're going to put an end to that. And we're going to have, I believe, about 2 years, assuming this bill gets passed. Again, who knows what's going to happen. We're going to have about 2 years to get that out of there, where you're going to lose your exempt status and making all of the contributions ineligible and likely subject to excise taxes.
Yeah, so the child tax credit is something that we've probably heard about over this past year. There was an increase for children over 6 to 3,000 and children under 6 to 3,600. And so the big hubbub about that you probably heard the last year is the fact that it's refundable credit and the advanced payments of it. So over the last year, I think you've been able to opt out of it if you wanted to and not get those advanced payments. I opted out of it. I think Bob opted out of it as well. Just kind of taking our own tax consideration into mind. I did see as well recently, I think, that the IRS, they have a portal out there that you're able to do some of these things and make some of the changes. I think one of the recent things that they added was changing your income limits. So one of the reasons I opted out was because I was going to be at that threshold where it was going to start phasing out, and I didn't have any way of changing my income, so I didn't want to pay anything back later on in the year. A couple other things with that, just to kind of get into the details of it. So they increased the age to 17. Before it was 16 and under, where you're eligible for the credit. Again, refund started in July of 2021. In the Build Back Better Act, the proposal is to extend that to at least 2022. I think with they wanted to extend it longer than that, at least permanently, or at least for a few years. But the idea behind it is extend it for a year, might include it in like extender type things to keep it going for the next however many years. It keeps getting approved to go for. Okay.
Yeah, so if you think about the child tax credit and the life of it, it started back in 98, back when we had a balanced budget, and we were able to try to get dollars back. So that's kind of changed over the years, and it's kind of increased. And we saw under TCJA where we saw the big bump from, I believe it was 1,000 to 2,000, 1,400 of it being refundable. Mainly why they did that also was because it phased out the personal exemptions, right? I talked about that a few slides back. So we don't have that anymore. So it's kind of a way to subsidize that. So if you had a kid, you weren't losing too much. This bump has really put a lot of dollars back into the economy. And what they were trying to do, from my understanding back when Congress first enacted this, reading the bills and legislation or white papers, was try to get dollars back in people's hands during COVID, right? This was a COVID-related item to try to get us in. That's why they made it refundable. Starting in was July 15th. We got our first payment. Pushing it forward, going into next year, we're going to see what's going to happen. I don't know if this is if it's going to continue to carry, especially on the GOP side, but we just don't know. It's interesting about the age increase is it got bumped to 17. The reason why it was 16 and under is because you were supposed to get it for the first 17 years because you got day one child was born, not their actual birthday. So now you get it for 18 years, which is kind of nice, especially if you had a child who just turned 17. So you get an extra year out of it. One thing to note also is the old credit still is there. So if your income limit is above 150,000, maybe it's 200, 250 or something like that, you still have up to $400,000 to get that initial $2,000 credit. You're not going to be phased out of that amount. One of the nice things that they've added, at least I think it's nice to me because I have young kids that are in daycare, is they've changed up how this credit is done, and they've expanded it quite a lot. So boiling it down, in prior years, you were allowed up to 3,000 of expense or 6,000 for 2 or more kids for dependent care expenses, and you got 35% of that as a credit. But it was phased down to 20% if you made above $43,000. Well, that's a pretty low phase out, especially thinking that it starts at 115K. So they've realized that and they've kicked it up quite a lot. Now we're going to be allowed more expense. So we're going to be allowed 4,000 and 8,000. Additionally, we get 50% of it phased down to 20%, but that phase out doesn't start until $125,000. So in broad streams or big picture, if you made $100,000, let's just say, right, you'd been phased out of the old credit and you basically get $600 per kid subsidized, or you got this credit for it. Now you're going to basically get $1,400 more if you walk through the math. On top of it, it's refundable now. So if you aren't in a situation where you're making too much money and you're able to use this, you're going to get those dollars back to help pay for it. So I think that's kind of nice to help with working parents. And rolling back, Build Back Better has a lot of spending for childcare, and that's one of their main thought process is to try to help subsidize these costs of working parents. So.
Yeah, and I think just to add on that childcare credit a little bit, I think it's a specific situation case for sure, but I think it's a unique planning opportunity too. I know personally, I was able to kind of look at this a little bit more and dig into a little bit more with 2 kids. I have twins that are in daycare, super expensive, but was able to do some things from a tax planning standpoint and from a retirement conversion to Roth standpoint to kind of save us some money taking advantage of that credit. So it is something to keep in mind if it applies to you. It's definitely a unique opportunity to keep in mind. The third stimulus, if you'll remember, we received earlier this year, which was kind of, I think originally they were talking about a $2,000 payment. The first payment that we got towards the end of 2020 was $600. So this third stimulus was kind of the remainder of that. The main point of this is to keep in mind to include that on your return for this year, basically.
Yeah.
Yeah.
Because as you guys have the third stimulus, we also have that child tax credit, which is refundable, yep, which we need to also keep track of and deduct correctly, because that is not not unlike the stimulus. That if you aren't entitled to that child tax credit, you're not going to be able to deduct that on return, meaning you're going to have to pay that back. Whereas this third stimulus, if for whatever reason you were fully phased out at 160 this year and you got it, who cares? The IRS says just keep that money. So, and the one thing to note on this third stimulus, that cutoff is a lot harsher, but it's something to consider as we're doing your last return, because again, we think of those stimuluses as 2020 stuff, right? It's all in our brain last year. I actually forgot about it until I was reviewing the tax law as well. But no, something to consider as you're wrapping up your returns. States, we're getting kind of tight on time. We haven't gotten to business yet. Good news here is they've removed pretty much any language on the estates, which is great news for a lot of us. So the exemption is still 11.7. It's going to be that way until 2026, where it drafts back down to TCJA rules, unless there's an act of Congress, obviously what they were trying to do. The main point on this slide that I wanted to talk about was they were trying to get grantor trusts included in your estate if you passed away. This wouldn't have been effective until next year. And why I bring that up is as we're continuing to look at year-end plannings and stuff to do, consider those types of grantor trusts like a SLAT or an intentionally defective trust that allows you to keep the assets for income tax purposes on your return, but for estate purposes out of your return, out of your estate, because they're trying to attack this. So it's just good to review that. And again, we don't have enough time to dig into it. It's a lot of fun, but we can get to that if you have specific questions on that.
Yeah, so just some miscellaneous other individual changes. There's a $300 if you're single, 600 if you're married, filing joint above the line charity deduction for 2021. You don't have to itemize to get that deduction. You just get it if you contribute that much to charity. There's a permanent extension of the 7.5% floor for unreimbursed medical expenses for and your itemized deductions. So there's in the past it's kind of gone back and forth between 10%, 7.5%. That's been made permanent at 7.5% floor. There's proposal in the Build Back Better stuff to excess business losses. Back in with the TCJA, excess business losses, there's a limitation put on those. The proposal is to extend that limitation and make those excess business losses not NOLs as if you carry them forward and make them still subject to excess business loss limitation rules. And basically what those are is you can't take those business losses against ordinary income. Another thing is the deferral of self-employment tax or SC tax until 2021 and 2022. That was something that came up with COVID. The one thing to keep in mind on this is to be careful of the payback. I think Bob had read some articles that if you are even just $1 short on paying that deferral back, they can penalize you on the whole amount, not just that dollar that you were short on it. So just something to keep in mind with that. And the 7203.
Yeah. So on that, it blows my mind on that deferral that they're saying, hey, if you're $1 short, we're going to be able to assess tax on the full amount. I'm not why they're doing that. I don't think Congress or the IRS like the deferral of these dollars. So that's why they're kind of going after that. So I've been in talks with clients right now. We haven't seen a lot of legislation or reforms on how we're going to calculate this, but I'm just advising clients to pay back a little bit more just to be safe, right? I mean, these were those deferrals that are due December 31st of each year. Just pay back more and just be a little safe on that. And then this last thing, reporting of S corp, sorry, cut in here, but it basically most of us know that partnerships had a report basis. They've now gone to S corps. I think this is just something that should have been done a long time ago. Why it's not done, why it's not tracked. It just makes life a lot easier when we actually know our basis and it's actually reported so we're all on the same playing field, especially when you get a new client trying to recalculate the stuff is almost impossible. So that's why they're instituting it now. So jumping over to corporations. So there weren't a lot of changes in this new in the Build Back Better. So hopefully we can hit the higher points here and kind of move on fast. So most of us know the triple P. Thankfully, that's done and over with. Speaking for myself, selfishly there, I spent a lot of time reading up on these laws that were changing. I know we're all probably thankful that it's done. It was great. It worked, got money back into clients' hands, but it was just a painstaking because it kept changing the rules. A couple things to point out to you. As you're applying for your last round, don't forget that interest expense is deductible. Meaning that if it got forgiven and you know what it is, you can still take that as a tax return expense. And anyone who has A, E, and P, which is that accumulated earnings and profits, so you were C Corp, now you're an S Corp, be careful distributing it out, any of the PPP money, because of how it's classified. If you have that unique situation, happy to jump on afterwards and chat about that.
Yep, so the corporate tax rate, no changes here in any of the proposals. So it's a current flat 21% rate. And some of the House Ways and Means Committee reports and some of the other initial bills, they were kind of proposing a graduated tax rate up to 26.5% for the highest earners. And under that proposal, personal service corps would not have been eligible for those graduated rates. But again, nothing in any current legislation. So still staying at that flat 21% for the foreseeable future. One of the things that is in the Build Back Better is a 15% tax on large corporations. That's any corporations with income over $1 billion. And kind of as an aside to that, there's a kind of global minimum tax, about 15% kind of proposal in there that's being talked about as well. So, so jumping over this real fast, and this just kind of point out the fact that we don't know what's going to end up in there. So they, in the original bill, they put in there that if you were an S corporation before May 13th, 1996, you were able to convert tax-free to a partnership. Why that? That's when they checked the box. Election came about, and Section 311B, my favorite code section. I know I'm favorite code section. Is basically says you can't take any
without being basically a taxable event. Because most of the time we've depreciated everything down to zero. So of course the fair market value is going to be above the value of it. So again, we don't know what's going to happen. We don't have a crystal ball that's going to show it, but just be cautious of things that could pop up because no one had this on our radar. How this came about, we don't really know, but it is in the bill. So just something to be cautious of. So 199A is still there. They were trying to repeal it for anyone above $500,000. They haven't. So that's that 20% deduction that we get on business income for flow through. They kind of make everyone not flip to a C corp. If you remember when we were dropping down 21%, it looked really appetizing to jump over to C corp. When they instituted this deduction, which made your taxable top tax rate 29.6, so still keep it an arbitrage rate. Nothing really here. This kind of stuff that is still in effect. Kind of just want to point out there that the ideal wage should pay anyone 28.57%. And charitable contributions no longer subject to QBI, stuff like that. So provisions, keep those in mind. You can still switch to cash basis, recorded inventory. If you're considered small business under 26, completed contract versus percentage completion, stuff like that.
Hey guys.
Yep.
You guys are getting some distorted audio. Can you try muting yourself and then seeing if it gets better?
Is that a little better?
No, might be a connection issue now.
We'll just try to come back in.
Yeah, that might be best.
Okay.
While they're doing that, just as a reminder, if you have any questions, feel free to put them in the chat box. And I threw a question out there. I think a few of you answered. I was just curious when they were talking about the virtual currency, if anyone uses that. Are you using it personally? Do you accept it? I recently had a conversation with a member who said one of his suppliers or someone could only be paid in virtual currency. So I was curious what you guys let them back in, if any of you are using it, accepting it, and where you see the future of that is. So if you have any thoughts on that, throw that in the chat as well too.
Is that any better?
Yep.
All right. All right.
Technology.
Yeah. All right, so the employee retention tax credit, probably the last big thing that we want to touch on, and probably something that might be being underutilized. I don't know. Let's see.
There we are.
All right, sorry about that. Okay, so the employee retention tax credit is probably the last big thing that we want to talk about. Probably something that's being a little underutilized, but it's available for 2020 and 2021 on a quarter-by-quarter basis. There is some legislation out there to end it after Q3 of 2021, and that's just because they haven't seen a lot of businesses taking advantage of it. So they just don't see a need to keep it going for the rest of the year. Kind of bypassing the details, you can be eligible by a couple of different ways. There's either a government order that if you were fully or partially shut down due to a government order, you can be eligible for that, become eligible for the credit for that duration of the order. Or if you have a significant decline in gross receipts for 2020, that decline is defined as less than 50% of the gross receipts for the same quarter in 2019. So, and for 2021, that's less than 80% of the gross receipts for the same quarter in 2019. If you look at the potential credits that are available out there, for 2020, you are available credit is 50% of the first 10,000 in qualified wages per quarter with a cap of 10,000 for the whole year. So essentially 5,000 per employee is the cap of the credit that you can get for the year. 2021, they upped that percentage to 70% on the first 10,000 in qualified wages per quarter, and there's no annual cap. So there's some big dollar amounts for sure in 2021 available to it if you're eligible. There's some other nuances there from a large employer, small employer standpoint, things to look at, a little bit more to dig into, but it's something to keep in mind for sure. We've had some clients get some big dollar amounts back, and it's been a huge benefit for them. Other than that, I think if there's any questions, I think I saw some chats in the last one that we were in, but it looks like we kind of lost some.
There was a question on timeline, if you had any idea of when they would vote on this and if it passed implementation.
Yeah, so great question. So they were hopeful to vote on it today. However, Joe Manchin came out last night and said he's not going to vote yes today. They want to, as Ruben said, to bifurcate those two bills that are out there right now, that infrastructure and the Build Back Better. They want to pass the infrastructure now, which has bipartisan support. However, a lot of the progressive Democrats have said we want these passed at the exact same time. So there is this inner fighting between them all. We're hopeful to at least get that infrastructure bill passed here shortly, and then probably won't have much traction until December on this. My expertise or my experience, I would say, not expertise, definitely. My experience is this, is they always wait till about December 27th, 28th to pass this tax laws, because they know that we're going to stay up for New Year's and read it all.
Do you feel the changes that they made to the Build Back Better make it more pro small business, or did they take out some things that were really beneficial to small business?
I would say yes, it is better for a lot of individuals as of right now, and especially the small businesses with pass-through income, right? Because we saw those tax rates at $400,000. You could have a great year and get subject to 39.6, and the next year have a down year just as quickly. So I do believe that what they've done now is stripped away some of those things that were hurting the middle America. So I do think it's a lot better for pro business and small businesses around.
Okay. I think those were the questions I had. Does anyone else have any questions? No? Okay. Well, thank you both so much for presenting. And we will have your slides that when we send an email out to the group, we will send the slides out to that as well, which thank you for putting your contact information there as well. We very much appreciate everyone being on. I want to let the group know we also have a webinar tomorrow morning at 10 a.m. We have Dr. Andrew Kite, is an executive in residence here with the Family Business Center, and he's going to talk about family business governance. So that's tomorrow at 10 a.m. If you need the Zoom link for that, feel free to send me an email or put something in a chat and we will get that out to you. And as we mentioned before, this is being recorded. It will be on our YouTube page, and we will put that link in the email as well, so you can go back and refer to anything, or feel free to share with anyone who might find this information valuable. All right. Well, thank you everyone for joining us, and have a great day.